Good morning to everybody, and on behalf of my colleagues, once again, a heartfelt welcome to the first annual OECS Summit. We are very proud and happy that the host asked us to be the lead sponsor for the first inaugural summit. We hope there's many, many more to come. Welcome to all the dignitaries, diplomats, speakers, attendees, special guests, friends, and I'm hoping that we're gonna keep it short, maybe put a little thought into your brain with my remarks and go from there. I wanted to first give a special shout out to Shanice Francis. Where's Shanice? Is she? I don't know where she is. Having been doing this as my bio, I don't want to add up all the years, but many decades. Doing conferences is not easy. And this lady has worked tirelessly for the last month and a half to put this all together. And for the first annual one, right on target. I'd like to also quickly acknowledge my team. Team Jefferies, part of the team is down here. There's Matt Kennedy. Matt, would you just stand? Matt is my partner, Managing Director of Jefferies. Alana Block, please stand. She's kind of our right-hand man in Atlanta. Patrick McWalter, Managing Director at Jefferies in New York. Felix, there you are. Felix is in New York, Miami. I'm New York and Miami. And last but not least, St. Lucia's own Franklin Colomar. Frank, please stand up. So if you get a chance to say hi to them, I'm sure that if not, they'll say hi to you. So as we're not at the halfway point here in 2025, it brings me great solace that this conference will hopefully shine some needed rays of hope and excitement during these challenging global times that we face as seasoned investors. At Jefferies, we are honored to be the global lead sponsor to this inaugural summit, as well as remaining totally committed to the Eastern Caribbean region. We are truly honored to be partnering with the Bank of St. Lucia and BOSL Fund Management Company in hosting this exciting event that I'm sure that all of you are going to enjoy over the next few days. As Managing Director at Jefferies, my mandate is to serve our clients with the absolute best we have to offer as a firm. At Jefferies, we continue to pool our talent and resources to create the best workable solutions for our clients throughout the Caribbean and the rest of the world. The global markets continue to evolve at a light speed pace that I've never seen in 41 years in doing the investment business. At Jefferies, we are talent-driven, we are visionaries with core values, but most of all, we are client-focused. In short, our primary directive is to deliver to our clients throughout the globe. Before I dive in, I'm going to chat a little bit about the U.S. markets, at least from my standpoint, and then a little bit about the Eastern Caribbean. I always have to have a disclaimer, and given the fact that a couple of my teammates here are actually from our compliance department, I got to make sure you all hear this pretty clearly, is that my comments may or may not represent those of Jefferies LLC, okay? So please take note of that, write that down. Felix, okay, good to go? He gave me the thumbs up, I'm good to go. So I was in Asia during the first few weeks of this year, and I was reminded that 2025 is the Chinese Year of the Snake. And given these immense volatile markets since the end of last year, that label seems rather fitting to me. It's perceived that these years of snake bring obstacles and generally prove to be transformational. Considering the prior years with the very same label, we're looking at 1929, 1941, 1953, 1965, 77, 1989, and 2001. These were all years either with economic maladies, recessions, or political and financial instabilities. Historically, during the years of the snake, the S&P on average ended those respected years with about a negative 5% return. So let's hope that the global markets turn a little bit more stable to avoid that precedence. Regardless of what the second half of 2025 will bring from both an overall economic and market perspective, I'd like to read a quote that was published a few months ago in Barron's, and I quote, "Parties, after all, are often followed by hangovers." I've been doing this for a long time, and I'm a bit doubtful that the S&P can post a three-peat of plus 20% returns. Putting the year of the snake aside for a moment, one thing is apparent to me. The U.S. Fed will soon continue to normalize rates, maybe a bit slower than many of us suspected a few months ago, but they'll still be lowering rates, and that's exactly why I continue to believe that locking in yields within fixed income is the right thing to do. It's always proven to be the right trade when the Fed is in accommodation mode. However, given all the moving parts in this uncharted global landscape, patience will be needed no matter what sort of securities you feel comfortable owning when it comes to investing in general. From my perspective, current earning growth projections in the U.S. still remain too lofty for my own palate, even though with the AI craze having some solid rationale behind it. So I continue to remain in a defensive posture because of my own past experiences in dealing with overstretched valuations of markets in general. To me, it really seems like deja vu all over again. Memories when I personally saw the eerily similar craze called the internet in the late 90s that led to the dot-com bubble bursting a few years later. The internet, like AI, was a real game changer. But when the markets price in all the upside valuations at once, history tends to repeat itself. True, these AI stocks are real companies with solid growth, unlike the internet companies back in the 90s. But the market's primal emotion seems unrealistic and unsustainable to me. In other words, the market valuations are pricing most of these assets as being riskless. And I've learned over the years that nothing ever moves in an upward straight line in perpetuity. And when it comes to investing, riskless securities just do not exist. I have learned the hard way that when momentum markets prevail over true fundamentals, corrections can be toward, they can be quick, like I witnessed back in 2000. And it's for that very reason that I remain pensive. I've seen this before, and I can tell you that even though I will never likely fully participate in these speculative upside environments, I will remain insulated and defensive, so when the markets revert back to the mean, as they always do, I will be enjoying some restful nights of sleep while others lay awake. I underscore my thoughts here by saying that to me, too many analysts on Wall Street have set the bar way too high for the returns here in 2025. And this brings me full circle as to why I remain of the opinion that solid fixed income securities look cheap and stocks still look expensive even after April's pullback. It was just a few days ago that Moody's downgraded U.S. debt, making it the first time in history that all three agencies have taken the U.S. out of the AAA space. From my lens, that move created more questions than answers for the Fed, and now truly has the FOMC between a rock and an even harder rock when it comes to resumption of their well-telegraphed accommodation. And even after the move by Moody's, after 2 years of stellar S&P total returns, many are still believing that this ongoing buying on the dip mania is still well justified. Regardless, it remains a very noisy landscape that we all must contend with. I can't tell you what the markets might or might not do in the coming weeks, but I reiterate what I do know. I do know that the Fed will indeed be cutting rates, and they will be doing so in the not-too-distant future. However, it's my opinion that due to so many unknowns that still exist out there, the FOMC will likely be late with their next rate cut, and it will, in my opinion, evaporate Fed Chairman Powell's hopes for a soft landing, and therefore force him to make more aggressive rate cuts later on in the year. So Moody's downgrade move might have turned out to be a gigantic yawn over a week ago. But from my lens, it's a gigantic wake-up call that needs some serious tending to. It may be viewed by many as a non-event, but in 2011, when S&P also downgraded American debt, The subsequent market chaos that follows was nothing short of breathtaking. However, unlike 2011, the Fed does not have our backs this time, and the Fed funds rate is plus 425 basis points higher now than it was back in 2011. In 2011, real rates were sitting at 0%. Today, they're right around 2%. So I remember so well back in 2011, there was no other alternative but stocks. But in today's world, you can garner a 4.8% on a short-term dated paper, which from where I sit looks just fine. Not to mention the long bond, the long US Treasury bond at 5%. If you want to go out and capture 4% free cash flow from the S&P, then knock yourselves out. But again, history has taught me some harsh lessons. Given all this ongoing volatility of late, the market greed factor is now fast approaching that extreme level again. And guess what? It happened in 6 weeks this time. Something that I've not witnessed in my 41 years in doing the business, and something that I deem as not being normal. It's nothing short of manic investing, and it sorely reminds me of the painful days of the dot-com era. The earnings yield on the S&P 500 has been sitting below what's offered by the 10-year Treasury since early 2024, a development that was last seen in the aftermath of the dot-com bubble 2000. I've always thus been guided by the rule that the higher gap between the payout on stocks versus bonds, the better investors will get paid for owning more equities within their respective portfolios. Ergo, it remains my opinion that U.S. stock market is running out of wiggle room here. Make no mistake, the complacency is an extremely dangerous state to be in, given all the unknowns that are currently out there. Similarly to the past Reaganomics era of the 1980s, which I'm sure many of you are going to have to start Googling while I'm talking. When I first entered the business in the mid-80s, the current administration literally was trying to get things back on track, and that was the entrance of Ronald Reagan. But few forget it was not after a few years of immense pain from ongoing volatility. It may be fun times for day traders out there in today's world, but in my opinion, again, it's the right time to play a solid defense. If I would have told anybody back in the 80s that the Ronald Reagan revolution would begin with a bear market, I would have been the laughing stock of the investment community. And they would have basically carried me out on a gurney to an insane asylum. It just goes to show you that nobody is larger and meaner than Mother Nature. History has taught me that nothing can stop a normalized market cycle that always reverts back to the mean. By the way, as a side note here, if you had bought solid bond credits during the new Reagan administration and had the patience to hold, it would have executed the trade of the century. For me, this is no time to be following the herd. Rather, it's time to understand that fundamentals matter when the timing is right and the mania has faded. And it's my belief that we're fast approaching that moment in history again. It's for all of these reasons that I remain a staunch bond bull with the personal experience of history on my side, as well as knowing that the Fed will move rates lower in the coming months. Finally, make no mistake that President Trump has dished up some serious market unknowns that will hopefully create better trade arrangements for the United States. But in the meantime, the expense in doing so translates into a much muted U.S. economy that is no longer being injected by both fiscal and policy accommodation. The cleanup process towards a more normalized wave of market cycles is going to create trepidation and volatility as we painfully make our way back to a market that is normalized and that has been eerily absent for decades of excessive U.S. government spending. Being weaned off stimulus is not an easy habit to kick. But once the process is complete, I believe the United States will once again be on the current and straightforward path and trajectory for organic growth once again. Now on just to a few comments on the Eastern Caribbean. The Eastern Caribbean financial sector has undergone remarkable transformation over the past decade or so, evolving from a collection of a few offshore financial jurisdictions to a seasoned and sophisticated regional financial ecosystem with increasing integration. I have witnessed the maturity of the Eastern Caribbean financial sector morph into a stable, sustainable industry that is proven to be quite resilient. The ECCB has provided crucial monetary stability through its currency peg to the US dollar since 1976. This stability has served as a cornerstone for the financial sector development across all these respective islands. Even the ESCE has expanded from primarily government securities to now including corporate bonds and equities, thus enhancing capital market depth and providing new investment vehicles for both local and the international investor. Following the financial crisis of 2008-2009, I was amazed as how the Eastern Caribbean jurisdictions had implemented substantial reforms that have now created a very seasoned environment in a relatively brief period of time. These reforms have shifted the region's position from tax havens towards legitimate international financial centers with sophisticated service offerings. I tip my cap to all of you for the ongoing process in the solid system that has pushed the Eastern Caribbean towards a true working framework. Hopefully over this conference in the next 2 days, we will push that stone further, and all of you will work diligently together to keep this going. Just looking at St. Lucia, for example, I've witnessed a traditional tourism-dependent economy rapidly evolve into a diversified economy. It remains my hope that these leaps of growth continue, and they do so in a thoughtful and traditional manner that will position the island into not just a regional marketplace, but a globally recognized country to do business in. At Jefferies, we hope to assist these efforts in the coming years, and we are very, very excited about St. Lucia and the rest of the Eastern Caribbean's overall prospects. Thank you for listening to me. Just some short remarks, and looking forward to meeting all of you at the conference over the next few days. Thank you.